I'm gonna buy 100 shares and sell them back 10 different times on the 18th. And then I get 3,000 free shares. Wicked smart. What are the reasons from what you know that we could see a NOPEX instead of an OPEX? Okay, so here's the problem. Generally, OPEX is a combination of two things. We have market maker buying, and we have obligation settlement from ETFs. Okay, so the reason we have market maker buying is because we go into OPEXs with negative delta, right? Which then needs to be, balanced back to neutral. In order to do that, the market maker has to buy shares. So all these options are expiring with negative delta, right? And then this forces the market maker to buy shares to achieve neutral. That, combined with the obligations from ETFs, gives us rapid upwards price acceleration. Okay? This time around, the market maker is neutral. Actually, slightly positively hedged, right? So, meaning that when these options expire, the market maker will need to sell shares to achieve neutral. Which means for this OPEX, because, we have the market maker exposure here, and this is the expiration, that the market maker will be selling into ETF purchasing. That's what we don't like about it. Now, don't get me wrong, once the market maker achieves neutral, if FOMO is still carrying on, then the hedge can move positive again, and they will start buying shares to hedge the upside. So we can still, snap out of that. But so the bump is softer? Yeah, potentially. A lot softer, right? Because you have, they're opposite forces. So say that creates some, consolidation essentially, right? Because you'll have, ETFs buying, market maker selling, ETFs buying, market maker selling, ETFs buying, market maker selling, so on. If the ETF buying continues, right, beyond the market maker achieving neutral. So say the market maker achieves neutral here. They're delta neutral. And the ETF buying continues, that can start to drive the price up, right? And then the MM will be buying to hedge the upside. So, after the market maker achieves neutral, it will then move over. If the ETF continues to buy, it will move over to the buy side and help drive upward price action. I hope that makes sense. It can offset some of the obligation of that, yeah, right? Because, it's just going to act counter to it, right? So, even if the XRT has double the obligations, there's still an MM selling into those obligations initially. Which means volatility, like we see with, like MMFTDs, it's a very similar situation. Because with MMFTDs, you have long and short FTDs, right? And so they create a lot of volatility, but they don't really create price improvement because, they're mostly evenly weighted and netted out against each other. And this is kind of a similar situation because there's a long pressure and a short pressure. If the long pressure, like any consolidation period, if the long pressure exceeds the short pressure, then you move up. This is why ETF FTDs have a bigger effect on the stock because they are basically 100% net short. And so they create just buy pressure. Versus MM FTDs that are kind of a mixed bag, right? What's up, guys? Stream card, fluffy upset. Pigeon teeth. I figured the pigeon teeth made it. I figured the can kick June OPEX would collide with July OPEX, causing this perfect storm. Except for the positive hedge that we've picked up this week. That's why me and JFresh did not like the positive delta hedge going into this week. It's not beneficial to us running hard. Don't get me wrong, in the past, you know, his data doesn't go back this far, but there are times in the past where we have run like up into OPEX, but the only time we did was in January. November and January. I think both of these we were carrying a positive hedge into the OPEX run. But, you know, lots of FOMO here. This one was a little weirder. But we didn't run very hard, right? We like ran a little bit and then got rug pulled. It's not no, it doesn't kill it, but people need to know what's happening, right? So it's not that we think OPEX is necessarily dead. We do think there's obligations due, but those obligations have to outweigh the market maker's sell-off. Morning, Gurk, and all you pickles out there. Okay, let me clip that real quick so I can